Hello and welcome to another episode of Macro Monday. I'm James Brodie, Head of Learning and Development here at Onyx Capital Group.
I'm James Todd, Trader Performance Manager here at Onyx Commodities.
And I'm Will Cunliffe, a Research Analyst here at Onyx Capital Group.
We've got a busy week ahead, lots of data, and the week started with Donald Trump slapping 30% tariffs on EU and Mexico. So equities are starting the week selling off.
In China, we've seen record exports. However, this is mired by continued deflation.
We've also seen new all-time highs for Bitcoin, and silver is surging higher.
Firstly, to last week's data, the data out of the US was more secondary data. We had leading economic indicators. They continue to weaken, typically at these levels triggering recessions. We also saw Amazon Prime sales falling 41% on the first day. The National Federation of Independent Businesses, small businesses, there we could see the index continuing to decline. Uncertainty index dropped 5 points to 89. Employment changes dropped 6 points to -8. And prices remained firm, rising 4 to 29. So continued theme to the data. Employment's looking weak. Prices continue to rise. The only place we're not seeing weak employment still is payrolls.
Yeah, and even in payrolls, as we discussed last week, a lot of that was driven by kind of government sector jobs. The actual private sector payrolls was down pretty heavily, underperforming consensus estimates still. I think it printed at around 70. Markets were expecting 105. So that's still cooling. That looks like cooling to me.
Yeah, but what's very consistent in the other data is if price is rising, and we're going to start seeing the tariff prices filter through. This week we have CPI and PPI, and also generally employment's looking weak. What we have here is a chart. One standout move at the moment, people looking to invest, is Bitcoin. And you can see Bitcoin, we highlighted for several weeks that it was a sideways range, 111,000 at the top, 100,000 was the base. It broke through 111,000 and it's now trading this morning 122,500. It's up 7% since Thursday.
Yeah, I mean, it was coming up to, as we spoke about last week, that triple top, and it had clearly been testing the all-time highs, a fair few times. And then you've just seen this absolute swing in momentum. And I think my perception on that is it's, a damning indictment of people's confidence in all things US, and that they're looking for alternative places to put their money.
Also, we'll come to it in a minute, but equities are really struggling at these levels. And currencies, typically, you'd see currencies strengthening in this area, like yen, but that's not moving either. So where's the fast money going? Clearly Bitcoin here, but also we're seeing silver. Silver's up 10% in, I think, 3 or 4 business days as well. So we're seeing precious metals rallying aggressively. If we move on to China as well, we had data out of China. Last week, we saw more deflationary data. CPI fell 0.1% year on year, but PPI was down a whopping 3.6% year on year. But this morning we're seeing trade data come out, and we've seen record exports and also record imports of oil. Actually, oil imports since
2023 about?
Yeah, August 2023. So it's record exports, biggest imports of oil 2023. That's a bullish sign.
Yeah, I mean, it continues to be a bit of a mixed picture in China. I think that's a lot to do with the huge stimulus. It's been pretty targeted. So you've seen a lot of consumer repurchase programs, tax breaks for manufacturers, and we've also seen them try to diversify their export portfolio in terms of destination. China have kind of consistently had a goal of insulating themselves from exogenous shocks and foreign shocks. And part of that is, one, onshoring demand, so boosting the household consumption. And we've seen that pass through in retail sales. We've seen that pass through in vehicle sales. Another part of that is diversifying where their goods are flowing to. And we saw in the recent trade data, US shipments bound for the US were down about 16% year on year. That follows a 34% decline year on year in May. But exports to the 10 Asian countries were up about 17% year on year. So they're really trying to find other homes for their exports.
And if you're seeing, ultimately these data pieces here can be, working together to paint a good picture. Because if you're seeing deflation, but we're seeing exports and imports of, oil and oil products, which are often used as a feedstock, that indicates to me that the manufacturing side of the Chinese economy is doing well. But if you're having deflation, that could be an indication that the services side is floundering a bit. It's been a great Chinese project to try and move to a more consumer economy and rely less on manufacturing, but it looks as though manufacturing is the beating heart of the Chinese economy again at the moment. Now, whether this is a good thing or a bad thing, I can tell you one thing for sure. I think that Trump and the United States are very jealous of what's going on in China's manufacturing industry.
Yeah, for sure. And I think, in terms of the easiest solution to the issues in China at the moment, it is one of diversify the exports. It's much easier to find new trading partners than it is to onshore that demand. If we move on to the next slide, we can see outstanding yuan loan growth increased 7.1% year on year in June. And this has been kind of a key indicator, I think, for the CCP in terms of appetite for credit in China. After being burned by the housing market collapse, consumers have been really reluctant to take on credit, and we've just seen year-on-year outstanding loan growth decline and decline and decline. And you can see that the gradient of decline is starting to bottom out now. We are at lows since 1998, so it's still pretty soft. But seeing that turnaround will be key, I think, in China's recovery more broadly on the consumer level as well.
So what we just talked about US and the data, it's clearly still a strong economy, but data's weakening. We're starting to see the opposite from China, a weak economy, and it's starting green shoots of recovery, they always say.
Yeah. Although it is still a mixed picture. PMIs are still printing pretty soft. Again, you have this huge excess capacity, which is weighing on the headline inflation statistic. We're probably going to see, although the PBOC have said they're going to reduce their stimulus this year, we're going to still have the CCP is still going to have to provide stimulus. The consumer in China is still relatively depressed, but we seem to be finding a bit of a floor on things. Certain sectors of the housing market are starting to improve as well. So yeah, there's definitely green shoots arising in China.
Yeah, and of course we have to mention the tariffs. Yeah. The weekend. What we talked about this before. The good news comes out in the week, but the bad news, whether it's missile attacks or these extreme tariffs, comes out the weekend to minimise market impact. Yeah. But the tariffs, 30% on European Union. Yeah. We haven't seen what they're going to come back with.
Yeah, it's I don't know. These things seem to be struck at times when the market is least active, i.e. over the weekend. And what we had seen obviously was on the 7th of July, so last week, the initial round of tariffs were put in, and then I think Japan and Malaysia were sort of hit with actually a higher tariff rate than they had previously been sort of slapped on. So I think people in Japan and Malaysia were sort of probably scratching their heads and licking their wounds a bit. And you see countries like Laos and Myanmar who had been hit very hard with these initial Independence Day tariffs, seeing an easing of that. And the statements were welcoming of lower tariff rates, but ultimately these are still very significant tariff rates altogether. The question then became, would Trump tackle again? And he sort of over the weekend has announced these 30% tariffs on the EU. Ultimately, the thing to my mind that is remarkable about all of these things, and almost admirable in how blasé he can be. He can put these tariffs on with no clarity whatsoever about what they're going to cover, how they're going to be implemented. So yet again, we're in a situation where supposedly as of now, the EU has a 30% tariff or whatever, but who's implementing it? How is this going to be passed through?
And it's from the 1st of August, isn't it? But Lutnick's come out, the Commerce Secretary, and said that they won't be extended beyond that. That's a firm deadline. But now we wait to see what European Union comes back with, and I'm sure they will, and they'll think it through first. But this has to have an impact at some point on the markets. I mean, we see Bitcoin and silver surging. I'm amazed equities, they're just off 0.5% this morning, but we'll see in a second the trend lines, they're at key support.
Yeah.
If they start to go, we'll also see that while retail are adding to their longs, hedge funds, generally seen as the smarter money, are adding to shorts. So be interesting to see how it plays out
They
this
tried
week.
that before and lost to retail.
Yep.
So
Yep.
you never know.
We're also seeing in the US commercial mortgage-backed delinquencies are surging. These are now at all-time highs. Surged to 11.1%, a new all-time high, as I say. These have exceeded financial crisis levels. So there's a bit of underlying concern there as well. Certainly the banks are highly leveraged here. Again, interesting. It's a slow burn, but interesting to see how this one plays out. We had last week, we also had US Bancorp Tower in Portland, Oregon, formerly known as Big Pink. That sold for 12% of its original price 10 years ago. On to Brent, the Brent chart, you can see that's still pretty largely range bound. What are your thoughts here?
Yeah, I mean, it seems to have found its floor, and now it's kind of definitely a bit rudderless, looking for direction. I think a lot of people. So we had the Saudi OSPs, which printed pretty bullish. They were higher than the kind of the Dubai structure had implied, and I think even though we did get another outsized OPEC unwind, that was kind of overshadowed by the Saudi OSPs. And then looking kind of, more at balances. I mean, balances on the face of things at the moment look pretty bearish. Like we have a 1.8 million barrel build this year, a 1.2 million barrel build next year. But it's pretty clear that almost all of that surplus is going to China. We've seen China building inventories, as discussed in the trade data. They've been building in some cases at 1.7 million barrels per day. So their inventories are now at record highs, as we discussed on the other Flux Live podcast last week. So check that out if you want to hear more about that. But I think that's providing a lot of support to markets, as they're realizing these balances may not actually be quite as bearish as they look. It kind of looks a little bit like when Bush tried to fill up the SPR back in his presidency.
Yeah, I think the market definitely saw, that there was the International Energy Agency. They came out with reports last week, tail end of last week, Friday. You saw like a $2.50 increase in flat price. And that sort of strength has continued over into Monday morning. You also have, tariff uncertainty to a large extent. It's in this scenario is probably, looking into summer, where in the short run you're going to be needing, feedstocks for refineries to produce products going into maximum driving and commuting travel demand periods. You're going to be seeing a lot of demand over summer, and so if there's any shortfall in terms of balances of product inventories and crude oil as well, that's going to need that gap is going to need to be filled. So I think a lot of the strength in front crude oil, especially, is being caused because of that. And what you're seeing is it's not necessarily implying that the rest of the curve, the whole Brent complex is going to be a lot stronger, but because you're seeing this front time spread, the premium for September Brent futures as opposed to October, that spread was trading at $1.20 a barrel. So people aren't necessarily fundamentally bullish crude and thinking that it should be going up in the long run, but in the short run, any shortfall is going to need to be filled.
Yeah, and I mean in the Middle East, we've seen Dubai price really quite strong. So physical premiums have been upwards of $3 there in recent sessions, and a lot of that is buying for China. I mean, on an ARB basis, Saudi Arab Light is pretty much as competitive as you can get. So delivered into China, that's the cheapest grade. So that's been really supportive of Dubai structure. And China just looked to buy on a strategic basis at $65, anything under 70, and even in the low 70s. And then obviously Trump loses patience as soon as Brent price is above sort of 75, and he'll come and tweet something that'll send it back down. So I think it's not surprising that we're kind of seeing this kind of pretty range bound and capped market at the moment.
And what's managed money doing?
So managed money has been increasing net length a little bit on a week-on-week basis, but I mean CTAs are still remaining pretty neutral. I think it's hard to kind of derive any impulse from that. The the CTAs in particular are still remaining stubbornly neutral. It's hard for them to trade in what's quite a headline-driven market. They suffered quite a lot during the recent bout of political tensions. They typically tend to like quite trending markets, and that's not necessarily what I'd categorize this current market as.
Yeah, that's one thing I love about actually our COT data is it gives us insight into what the CTAs are doing because they're trend following. And if you know they're starting to go long, you can see it, they're starting to go short. That's telling you that where the trend is, and there's going to be flows of money behind that. So that's great insight from our data. We move on to the UK data. We had some UK monthly GDP data came out last week. 0.1% month-on-month decline. We've mentioned this before. It's a bit, 1 month data is a bit random, but the previous month was a 0.3% fall. So you can see we're starting to get a bit of a trend here. And what we're seeing with that is the pound starting to weaken as well. It's got to be concerned for the Labour Party with their the pressure they're under and they're flip-flopping around policy. And we'll come to a chart on the next slide is the pound against the Australian dollar. And I bring the Australian dollar in because last week the RBA, the Australian Central Bank, the Reserve Bank, they were unchanged at their central bank meeting, and the OIS market had them expecting a full 25 basis point cut. And that's a huge surprise. Certainly with the Fed, Bank of England, other central banks will try and jawbone the market, lead the market. But here, complete surprise, the market was expecting a full cut. They didn't cut, they were unchanged. And if anything, they're on the sidelines and they're a bit more hawkish. So this is good for the Australian dollar. And you can see here, obviously, the pound's weakening on the UK data and sterling Aussie is rolling over. 205 is a sort of final support. Then it becomes a clear downtrend if it's not in that already. On to equities. Again, this is becoming fascinating. The momentum's completely disappeared now in the US equity market. And we'll come to the chart in a second. But just to highlight, the bulls will say that after past non-recessionary 20% drawdowns, which we had in April, the S&P typically rallies 26% the next 18 months. On the other hand, the bears will say that equity valuations are extreme levels. And you can see from the chart here just how extreme US equity valuations are. And if we move on to the next chart, JP Morgan highlighting they're concerned about the elevated level of investor positioning. The US households have close to record levels of equities in their balance sheet. But at the same time, we can see from the next chart, hedge funds are getting more bearish. Net positioning for S&P 500 futures is the most negative since March 2024. Even more negative than April this year when we're 20% lower.
Yeah, it'd be interesting to look at these previous things as well, looking at the historicals when you say, when you have everyone in April was suffering so much and over the next 18 months, historically you might be expecting to be in a bull market. I don't think that anecdotally, I'm not sure that the S&P or any sort of set of equities will have bounced back as quickly as what we had seen over Independence Day to, by the end of April, things were back on parity. So it's not as if, whilst people were stopped out, especially on a retail side, people were, seemingly adding length. I would be very reticent to say that you necessarily saw the suffering and the blood on the streets that you would see with past financial crashes because things were back up to speed so quickly. As a result, I'm not sure whether things are, you didn't see the bubble burst quite as dramatically as other market crashes. And so I'm not sure that an 18 months of a bull market is sort of warranted in the coming months.
But then again, on like a fundamental basis, you have the big beautiful bill that's just been passed. That's going to be reducing tax for corporates, and that will help equities. It'll also at the same time probably reduce allocations towards treasuries, especially at the back end. So you've got this kind of trade-off between, yields are getting pretty high, but for the time being, equities still continue to front run them. And I think people just want that exposure. Yeah,
companies and corporates are going to get hit as well. Their profit with these tariffs, for sure, profit's going to be eroded. Yeah. But I agree with you. One point, if you look back at historical data and said, well, if you look back, for the past 25 years, US equities have surged partly because we've had central bank policy, zero interest rate policy. If you look at European markets, for instance, or Japan, well, Japan was down from the late 80s, it only just recovered in the last year. So you can, if you can easily cherry pick the last 25 years, and that is a big period, but it's easy to be bullish on that. But in that period, you didn't have what we have right now with the tariffs and these ongoing events. Another piece of sort of concerning data from an equity perspective, Goldman Sachs highlighting weakening momentum. Their high beta momentum basket, you can see here from the chart, dropped 4.5% in one day. It's down 8.3% month to date. And what here, Goldman Sachs, their high beta momentum basket selects stocks that have recently outperformed, betting on continuations of their trend. So if it's selling off hard here, why does that matter? Well, sharp declines reflect reversal in crowded momentum trades. So sharp, aggressive sell-offs last week. Stocks in this basket include, well, look here, GE, Robinhood, Lemonade, Netflix, Tesla, Twilio, and Upstart. So there's signs of weakening momentum. And if we look at the actual NASDAQ, you can see from the chart here, there's a clear, you can see just how aggressively it's rallied. You can see it's a rising wedge pattern. And when, if ever, the trend line breaks, typically these rising wedges get aggressive moves to the downside. And this is from Friday's close. So again, we expect the market's going to open. At the moment, it's down about 0.6%, the futures. So we'd expect that to open lower. And again, we've had a pretty weak or lack of strength in the last couple of weeks. Personally, I expect this to go down, especially with silver going up, Bitcoin going up, concerns. But again, we have to wait till we see it in the price action. On to currencies, another standout here, another sterling chart is sterling against the US dollar. We mentioned last week how the dollar index was showing some signs of life again. And you can see there's a clear trend line here, comes in at 1.34, 134. A break below that, I'd expect to see more selling. But again, I don't know your thoughts here, but what I find hard with the dollar strength we're seeing in the last week is, yes, of course, we can see it in the price action, but doesn't make sense with silver going up, with Bitcoin going up.
Yeah, for sure. I mean, you know, theoretically, you would expect a currency to weaken under tariffs, and we've not necessarily seen that this time. You know, the first set of tariffs saw a huge amount of capital flow out from the US. We've seen a little bit of that in the strength in kind of euro dollar, but the recent strength in dollar does seem a little bit peculiar. I think a lot of that is to do with the huge gains in the equity market, and also yields are perhaps looking a little bit more attractive now. But then again, I think, you know, the whole fiscal sustainability side of the US is the equity market going to continue to run. A downturn there, I think, will trigger a lot of outflows.
Yeah, I love what you say there, theoretically.
Yeah.
Theoretically, it should keep going down, but right now it looks to be going up. And of course, the market, a key point is the positioning is incredibly short. Yeah. So markets move in waves, you typically get a pullback. And if there's dollar strength, well, that's the short-term price action. Yeah. I agree. Longer term, I think it goes down, but...
Yeah.
To what extent, if any, would you see dollar support because of alternative asset classes purchases being purchased in dollar-denominated units? So if you're looking to buy gold, if you're looking to buy Brent, if you're looking to buy silver, all of these are dollar-denominated. Do you see inflows of capital from, you know, Chinese speculators looking to buy gold in dollars? Do they have to convert their currency to gold? And do you see some short-term support on the dollar because of that?
So it's interesting with Brent in particular, because, you know, typically in the textbook you'll learn that it's an inverse dollar relationship, in that when the dollar's weak, that means that you get a bit of demand destruction from foreign importers. But we've not seen that at all. We've seen that inverse relationship completely break down and actually flip positive recently. And that's been more of a function of the kind of the dollar than it has been a function of Brent. So I think, you know, in some ways you're effectively swapping the dollar for a hard asset. So in that regard, it should have that inverse relationship. But yeah, we've not necessarily seen that hold up recently.
Well, I think it will be quite interesting as well if we see a bit more nationalism. So countries like Japan, obviously concerned about the impact of the tariffs on their motor industry, amongst others, but they're the biggest buyers of US treasuries. If they start to peel back on that and start selling the treasuries and going back in Japan, that will help Japanese government bonds.
Yeah.
And that would obviously help the yen, which has been incredibly weak. We haven't mentioned bonds this week. We have so many other charts, but as well, the 30-year in the US is back at 394. So yields are creeping up again.
Yeah.
So when that gets to 5%, debt gets into the spotlight again, and then you'd expect to see the dollar starting to weaken. But for now, as you say, the price action is the only arbiter of your P&L, and that seems to be strengthening for the dollar. On to dollar Swiss.
Yeah, I mean, this was a pretty interesting one as well, because, you know, the Swiss franc is typically one of these risk-off trades. So yet again, it's seen as a bit of a safe haven, similar, akin to gold. But I think one of the major, you know, sort of things that we've seen is obviously this dollar franc move has sort of been caught quite short. But if we move on to the next side, you see that the Swiss franc is now seen to be a risk neutral hedge against fiscal uncertainty. I.e., you know, we have pretty much flat rates on flat interest rates in Switzerland. They're looking perhaps even to go negative. And so people looking over to the US, and particularly looking, you know, by proxy at the Eurozone and worried about perhaps quantitative easing coming in, people are saying that the Swiss franc, you know, really does have this move as a potential safe haven against that. So seeing the dollar franc moving lower is no surprise to my mind there, as people look for alternative investments.
Interesting. As we move on to commodities, gold chart, you can see last week how it bounced off that trend line. Believe in technical analysis, whether you do or not, you can see clearly that can't be coincidence. Traders that do use it brought off that trend line. They have stop loss just below, and the market will be aiming towards that triple top 2,450 level. With silver and certainly platinum surging, you'd expect to see that follow through. If we move on to the next chart as well, copper, we had a big move in copper last week with the 50% tariff news. And what I find really disappointing here, that being an understatement, is we can see from the data clearly there was huge buying going on just before this was announced in copper. Also, dollar Brazil, there was huge buying announced, or we can see from the data just before that tariffs for Brazil were announced. And clearly these trades are being front run by someone within the administration, but it's being done in such size. I mean,
huge, yeah. And we just saw, you know, COMEX versus LME copper just blow out as well. The market was really quite concerned over the looming tariffs on copper. And interestingly, you know, the US does not have the copper infrastructure it needs to meet demand. I think only about 50% of its copper is produced domestically. The rest is imported, and they're slapping 50% tariffs on that. It's just going to close the arb, and their prices are going to rise in COMEX, and it's going to become dislocated from the LME and other exchanges.
And that will be inflationary in manufacturing, because copper is the biggest
completely
component of industrial metal of industrial
sector
production
that Trump wants to support as well, and stimulate.
But when you see front-running orders like this and clear sort of market manipulation, ultimately, given what you see on the data, I think that should provide healthy skepticism for any, you know, potential traders out there looking to get into copper right now. Because if you have, you know, a buy at best order on the open and suddenly someone else has already front-run it to the tune of millions and millions of dollars, you could be very shortly buying the highs and buying the all-time highs, and then be in a position that you hadn't anticipated.
Yeah, it's very reminiscent in some ways of the kind of the gold flows that we saw in the first quarter, where, you know, Singapore, Switzerland, all the gold was going into COMEX, and then we pretty quickly saw those flows reverse. And gold's a bit peculiar because the typical 800 ounce bar is not deliverable into COMEX. You need to smelt it into a kilo bar to then deliver it. So that there's a bit of friction in the arb there that's not necessarily present with the copper, but it's definitely reminiscent of that.
Interesting. And with silver, we move on to silver. You can just see how that surged Actually, this is a long-term chart going back to 2011. You can see 2011 in 18 months, it went from something like $8 to $50 before, interestingly, that collapsed when the exchanges raised the margin requirements. So the market fell then 33% in just 2 weeks. You can see here we've had I think silver's up 10% in a matter of 3 or 4 trading sessions. And you can see it's absolutely surging. Same with platinum. We're seeing all precious metals going. And you can see from the next slide here where the fast money's heading. This year, platinum's up 50%, copper's up 35%, silver 33%. But down at the bottom, if you look at the Magnificent 7 ETF, that's just down 3%. This is highlighted from Convert Bond, Lawrence McDonald, who was highlighting this over the weekend. And with that, he was also highlighting the irrational buying of Nvidia. So Nvidia became the first $4 trillion company last week. But you have price to sales now at 27 times, which seems
huge,
exorbitant. Yeah. But again, when we look at the actual chart of Nvidia, the next slide, you can see the price has doubled since April. But again, you have a fairly bearish candle on Friday. Again, it's trending up. You can see the moving average and it will keep trending up. The price action will tell us when it turns, but when it turns, I expect that to be another one that will go down just as aggressively as it went up. Another stock with an interesting chart, Meta. It looks like we're pretty close to reversal from a double top here. Again, the high is 748. And I'm looking at equities from a pretty bearish perspective here, but at the same time, I'm not being bearish across the board because we're looking at precious metals, just saying how bullish they are. And you'll see chart of the week when we look at palladium in a second, just how bullish that looks. Onto the OIS pricing, the market's still looking for 4 cuts by the Fed over the next year. And again, it's complete no man's land. We're watching data sort of day by day. We're playing off headlines. Don't know what Trump's going to tweet, but what we do know is he's a Chelsea fan after the weekend's performance.
Yeah.
ECB, just 1 cut. The market's starting to look at small sniffing at hikes next year. Again, I think that's a bit brave. I think we'd see more from the ECB. Yeah. Bank of England, 3 to 4 cuts this year. BOJ at the bottom, the market's starting to get more aggressively at hikes, 17 basis points of hikes priced in again. And onto that chart I was mentioning, chart of the week, palladium. You can see here a long-term chart, but you can see here how there's a double top there, 1,248. That's the final level of resistance. A break above there, and it will certainly break just like Bitcoin's breaking, just like silver's breaking. And because precious metals are breaking higher, and we have all that's going on with the tariffs and the uncertainty, it looks to me like that will become a crowded trade that will move aggressively higher. Yep. Again, key levels 1,248. If it breaks above there, opportunity to go long with a stop just below, a typical breakout trade.
Yep.
Which brings us on to this week's data. Busy week. Tuesday, we have US CPI, China house prices, China GDP, China retail sales, and German ZEW confidence. Wednesday, US PPI, UK inflation and retail sales. Thursday, US retail sales, Aussie and UK employment. A big week for UK employment. If it's weak, then the pound's going to get really hit. And more concerns about the whole debt sustainability. Friday, US Michigan consumer sentiment and Japanese inflation. Busy week ahead, lots of interesting price action, lots of headlines going to come out, we don't know when. We do daily updates on LinkedIn page, Onyx Institute, so please do look at that. And closing thoughts, how do you think we're going to see this week?
Yeah, I think it's going to be more headlines, more focusing on Trump's Truth Social, I think. Seeing who he slaps with potential tariffs next. Also seeing if anyone comes to the table and tries to negotiate and agree on any trade deals before 1st of August.
Yeah, fundamentally, I think even though, as we said, price to earnings ratios, etc., are all out of kilter, and Nvidia is 27 times, etc. I think I wouldn't be surprised if over the next week or so we see signs of a rapprochement to some degree on tariffs, and the market that had hardly sold off on these new tariff deals sees this as another bullish signal. So, even though from a fundamental perspective, I don't like equities. I think for the next week to 2 weeks, I think they could be supported. And yet again, it seems weird. You're having precious metals supported as alternative investment classes, but equities also supported. So maybe the one to go is going to be bonds, but.
And of course, Bitcoin as well. So interesting to see where the fast money flows this week. Again, a huge moves we've just seen in the last 3 or 4 days in Bitcoin and silver. We'll see if that continues. Interesting week ahead. Hopefully you've enjoyed this week's Macro Monday. We look forward to seeing you next week. Thank you very much.
Thank you.
Thank you.